I'm Alex. If you're new here, welcome. I analyze the US stock market from a Canadian perspective, focusing on what Canadian investors care about most. Before we get into it, quick disclaimer. This video is for educational and informational purposes only, not financial or investment advice. Always do your own research or consult a professional before making any decisions. In part 1, we talked about what to buy and where to hold it. Now, in part 2, I'm going to show you exactly how I execute my ETF strategy without screwing it up. This is the step where most investors make mistakes, so pay close attention. Here's exactly how I structure my accounts. In my RRSP, I hold only US listed ETFs. That's where my VTI goes, my QQQ, my VGT, all the US stuff. This is the account where I'm most aggressive with US exposure because I get that tax advantage. In my TFSA, I hold Canadian listed ETFs like VCN and XIC. Why not US ETFs in the TFSA? Because TFSAs don't get the same treaty protection, so you'd still lose that 15% US dividend withholding tax. Kind of a bummer, but that's just how it works. In my non-registered account, I try to keep as little as possible because that's where taxes hurt the most. If I do use it, I put Canadian dividend stocks there because of the dividend tax credit. One more thing on the tax and cost front. When you're moving Canadian dollars into US dollars to buy US ETFs, please don't use your bank's default currency conversion. They'll charge around 2 to 2.5%. That might not sound like much, but on $50,000, that's over $1,000 gone instantly before you even invest. That's straight up lost money. The classic workaround is Norbert's Gambit. It works, it's legit, and it can save you a lot on FX fees. But for beginners, it's not simple. You're buying one asset, waiting for settlement, requesting a journal, then selling it. Miss a step, and it gets confusing fast. Personally, these days I mostly avoid that whole process by using a broker like Interactive Brokers. Their currency conversion is basically at the interbank rate. Converting tens of thousands of dollars can cost as little as a couple of dollars, and it settles almost instantly. No waiting, no manual gambit, no extra trades. The point is, FX costs matter way more than people think. Cutting those fees alone has saved me thousands over the years, and that money stays invested and compounds. Okay, now let's talk about execution. Step 1, I focus on maxing out my RRSP first because it's the most tax efficient account for US investments. I contribute about $500 every 2 weeks, roughly $13,000 a year. But here's the mistake a lot of people make. VTI is priced in US dollars, and if you fund your RRSP in Canadian dollars and just hit buy, most brokers will automatically convert your money and charge around 1.5% to 2% in FX fees. That means you're losing about $250 a year before you even start investing. And on every $500 purchase, around $10 is gone instantly. This matters even more on platforms like Wealthsimple. If you're not upgraded to their USD account, every single buy and sell gets hit with a 1.5% round trip conversion fee. And even if you do have a USD account, the moment you convert Canadian dollars into US dollars, you're still paying a pretty chunky FX spread. That's why currency conversion quietly eats into returns way more than most people realize. This is exactly why I personally prefer using a broker like Interactive Brokers, where currency conversion is close to the real market rate and costs basically nothing in comparison. Or, if your broker supports it, learning how to use Norbert's Gambit can dramatically cut down FX costs as well. Once that setup is done properly, the strategy itself is simple. I buy on a fixed schedule. I don't try to time the market. I don't wait for dips. And when prices are up, I'm buying. When prices are down, I'm buying more shares. That consistency removes emotion from the process and lets compounding do the heavy lifting over time. Step 2, I mainly use my TFSA for Canadian ETFs and try to max that out as well. The TFSA is great for growth because capital gains are tax-free, but it's not automatically the best place for everything. If you hold US ETFs like VOO or VTI in a TFSA, you still lose the 15% US dividend withholding tax, and you can't recover it. That's why I keep my US exposure in my RRSP. With the TFSA, Canadian ETFs make more sense. You avoid withholding issues, you stay in Canadian dollars, and all the appreciation remains tax-free. I rebalance maybe once a year, not every month, not every week. Usually tech runs up and I trim a bit. Or sometimes Canada outperforms and I adjust the other way. I don't constantly tinker because that's how people overtrade and mess things up. The strategy is simple, but not easy. You have to stick with it when markets panic. In 2022, I kept buying even when it felt awful. And by 2026, I was far ahead of where I would have been staying overly conservative. Step 3, and this is important, rebalance maybe once a year. That's it. Not every month, not every week, just once a year. I check if my allocation is still close to that 60-20, 15-5 split. Usually what happens is tech runs up, so I'm overweight there, and I trim a bit, and I move it into my total market position. Sometimes the Canadian market does really well and I need to rebalance the other way. But I don't constantly tinker because that's how you mess things up and pay a ton of trading fees. Keep in mind that the 60% in VTI already includes roughly 30% tech stocks. And if you add another 50% tech-focused allocation like QQQM, your total portfolio tech exposure could be close to 40 to 50%. That's quite aggressive and makes your portfolio very sensitive during rebalancing. So be aware of that risk. Look, here's the bottom line. As Canadians, we have access to the most powerful wealth-building machine in human history, the US stock market. But you've got to play it smart. You need the right allocation so you're not too aggressive or too conservative. You need the right accounts so you're not getting killed on taxes. And you need the discipline to stick with the plan when things get tough. The exact numbers matter less than having a plan and following through. Just don't be like I was 2 years ago, sitting mostly in Canadian stocks, watching gains happen south of the border, too scared to make a move. That was expensive and honestly, kind of dumb looking back. So there you have it, my complete ETF allocation strategy for US markets as a Canadian investor in 2026. These aren't magic ETFs. The structure matters more than the tickers. If this video has helped you out, hit that like button. It actually helps more than you think. If you got questions about specific ETFs or want me to go deeper on tax stuff, drop a comment below. I read every single one and reply to most of them. This channel is all about helping Canadians build wealth in US markets without getting crushed by taxes or making rookie mistakes. So subscribe if you want to stay ahead instead of reacting late. I'll catch you guys in the next video. Peace. In the end, this video is for information and sharing purposes only, not financial or investment advice. Always do your own due diligence.